If your goal is to attain financial security and build substantial wealth, the secret lies in diversifying your investments with income-producing assets. While this advice may sound easy enough, the challenge comes when choosing the right kinds of assets to include in your investment portfolio. Many investors tend to stick with stocks and bonds, which are popular and effective wealth-building options. However, the world of investing is filled with opportunities beyond these two asset classes. So to help you make a much more informed decision when investing, I have compiled a list of 6 income-producing assets that have the potential to significantly boost your wealth. Asset number 6, a franchise. Remember the last time you visited Subway and had a great conversation with the store owner? Probably not, because those store owners are never there. Most of them outsource day-to-day operations to others, making their franchise a passive source of income. Investing in a franchise can be a lucrative business venture because you gain the right to use a well-established company's trademarks, trade secrets, and proven business model in exchange for a share of the profits. The requirements for starting a franchise vary by brand. For instance, McDonald's has one of the most expensive franchise fees at $45,000. On top of that, the required investment to build or buy a store ranges from $1 to $2.2 million, with a requirement of $500,000 in liquid assets. Luckily, the returns on such investments can be significant. For instance, the average McDonald's location generates around $2.6 million in annual sales. Franchises like Chick-fil-A have a more competitive selection process and demand more time commitment from owners, requiring them to be in store for at least 30 hours a week. On the other hand, franchises like Subway have a higher acceptance rate for applicants and allow absentee ownership, making it a more investor-friendly option. So when selecting a franchise, it's important to consider the expenses, obligations, and potential profits to align with your investment goals. Asset number 5, bonds. Bonds offer a secure and straightforward way for investors to provide loans to borrowers, such as individuals, businesses, or governments, to be paid back over a specific period, known as the term or maturity. During the term, the borrower makes periodic payments, known as coupons, to the investor until the total principal is repaid at the end of the period. When investors talk about bonds, they often mean US Treasury bonds, where the US government is the borrower. These bonds have different terms. For instance, Treasury bills range from 1 to 12 months, Treasury notes 2 to 10 years, and Treasury bonds 10 to 30 years. You can find the interest rates paid on US Treasury bonds for each of these terms on the US Department of Treasury website. Other than US Treasury bonds, there are other options like foreign government bonds, corporate bonds, which give loans to businesses, and municipal bonds, which provide loans to local or state governments. These alternatives may offer higher interest rates but come with higher risks. US Treasury bonds are a better option because they are widely regarded as safe due to the US government's strong creditworthiness and ability to print money to fulfill its obligations. Additionally, these bonds have low risk and often increase in value when stocks and other risky investments decrease. They offer a steady income stream and can help rebalance your investment portfolio during difficult market conditions. Even in challenging economic times, their lower volatility makes them reliable and valuable for generating income. Asset number 4, dividend-paying stocks. Dividend-paying stocks are a smart way to earn money regularly throughout the year. These stocks come from established companies that share a portion of their profits with shareholders. The payouts can happen monthly, quarterly, or annually, and the amount can vary depending on the company's dividend program. You can receive dividends in different ways. The most common is cash, which goes into your investment account and can be withdrawn or used to grow your portfolio. Another option is stock dividends, where you get extra shares of the company's stock instead of cash. Some companies offer special dividends as a bonus on top of regular dividends. The amount you get paid depends on factors like the company's payout rate and the number of shares you own. Companies with consistent earnings and good financial health make the best dividend stocks. Some of them are known as the dividend aristocrats because they have increased their dividend payouts for 25 years or more. For instance, Procter & Gamble and Dover Corp have been doing this for 61 and 62 years straight. If you want even higher dividend earnings, consider investing in companies like AT&T, which currently has an annual dividend yield of 6.05%. You can also find dividend-paying companies in various industries like tech, healthcare, banks, oil and gas, and more. However, it's essential to do your homework and not just chase the highest yields. Consider using stock comparison tools provided by brokerage and investment accounts such as JP Morgan to make informed decisions. However, if you are unsure which investment suits you, consider consulting a financial advisor. They can offer personalized guidance based on your financial situation and goals. Asset number 3. Real estate. Real estate has proven to be a key wealth building strategy for many millionaires. While it may not make you rich overnight, it can significantly increase your net worth relatively quickly compared to other traditional investments. One profitable strategy is house flipping, where you buy a fixer-upper property, renovate it, and sell it for a profit. This complicated process can yield significant profits if done right. The other way to build wealth through real estate is by owning investment or vacation properties. These properties provide you with a relaxing space and can help you generate additional income. If managed effectively, renters can help pay off the mortgage while you benefit from long-term property appreciation. However, it's important to note that owning investment or vacation properties requires significant effort and hands-on management. Dealing with renters, listing the property, ongoing maintenance, and handling liabilities demand time and attention. While the rewards can be impressive, you should be prepared for the additional responsibilities. The real estate market can also have its ups and downs, as seen in 2020 when Airbnb entrepreneurs faced difficulties. While returns from investment properties can outperform stocks and bonds, they come with greater involvement and commitment. If you prefer having more control over your investments and like the idea of physically owning real estate, adding investment or vacation properties to your investment portfolio might be a smart move. Just be prepared to put in the work. Asset number 2. Real estate investment trusts, also known as REITs. If you like the idea of owning real estate but don't want to manage properties yourself, real estate investment trusts could be an excellent option. REITs are businesses that own and manage real estate properties and distribute their income to their shareholders. What's even better, they are legally required to pay out at least 90% of their taxable income as dividends, making them one of the most reliable income-producing assets out there. But not all REITs are the same. There are residential REITs that own apartments, student housing, manufactured homes, and single-family homes, and commercial REITs that own offices, warehouses, retail spaces, and other commercial properties. Some REITs are traded on the stock market and are available to everyone, while others are only for accredited investors and are not publicly traded. Regardless of the type of REIT you choose, they typically offer returns similar to stocks and sometimes even better and with less volatility. However, like most risky investments, they can be impacted by stock market crashes, which means diversification benefits might be limited when you own them. When it comes to real estate investment trusts, always remember the golden rule of finance. Increased returns usually come with increased risk. So take the time to thoroughly study and understand the world of rates before making any decisions. But if real estate is not your preference, maybe this option is. Asset number 1, certificates of deposit or CDs. If you want to invest your money safely and reliably, consider a certificate of deposit. A certificate of deposit is a low-risk financial investment offered by banks. It's pretty straightforward. You give the bank some money for a fixed period, like 3 months or even up to 5 years. And during that time, the banks pay you interest on the money you've given them. The longer you let the bank use your money, the more money in the form of interest you'll earn. CDs are very safe because the government insures them for up to $250,000, so you don't have to worry about losing your money. But there are a couple of things to consider, such as inflation. The average inflation rate in the US has been 3.7% over the past 60 years, and for many CDs, the interest rates might not keep up, potentially leading to a loss in real value. In other words, your money might not grow as much as you'd like. Second, you can't withdraw your money before the fixed period ends without paying a penalty. If you're young and have more time to invest, consider riskier investments that could earn you more money. Also, if you have other financial goals like buying a home or going on vacation, a CD might not be the best option because you can't access your money until the term ends. Overall, buying this asset is a good choice if you want a low-risk investment that gives you peace of mind. Well, that brings us to the end of the video. Thank you for watching and staying with me till the end. And if you want to talk to a financial advisor for free, check out Money Pickle. The link is in the description below. Thanks for watching and have a great day.